Okay, before we start, okay, audience, would you, if the risk assumptions were exactly the same, would you rather have a stablecoin backed by USD or backed by Bitcoin and ETH? Raise your hand for USD. Raise your hand for Bitcoin and ETH. Yeah, okay, so actually most people prefer decentralized stablecoins. Thank you.
Are we done now?
Yeah, we're done.
All right, so we're waiting for Evan, but I think we can. Here we go. You can come sit here. Do you have a mic? I think you might need a microphone.
I'll just yell.
Sounds. All right.
Who am I on
Welcome.
stage with? Who are these guys?
Thank you.
All right. Are you all sitting under your names?
Wow, this is a
Perfect.
cracked group. Wow.
So, yes, I'm filling in for Matthias, who's unwell. So I apologize if I don't understand the answers to my questions. So maybe let's start with Tao. Can you introduce yourself very briefly?
Yeah, sure. Hi, everyone. This is Tao. I'm the co-contributor of the AladdinDao and also the FX protocol. I started with a community member of the AladdinDao, and I like the product. Then I started to writing more proposal and getting involved in the community more. Then last year, also on the Stable Summit, I was attending as an intern and introduced about the protocol. Then after that, I joined the full-time working for the FX protocol. Yeah, that's for me.
What about you, Joseph?
Hello, I'm Joseph Schiarizzi at Cup of Joseph. I'm building a new stablecoin called Nearite on Arbitrum, and I've been a contributor to Liquidity, Let's Get High, Open Dollar, among stablecoin projects, and a lot of other DeFi protocols. So thanks.
Hi, I'm Phil. I'm building Cork protocol. We're building a new DeFi primitive to tokenize risk. So basically, we're building a way for you to trade and hedge the risk of depegs on stablecoins, LSTs, LRTs. Basically, the easy way to think about it is, as long as you're not a regulator, it's a credit default for pegged assets.
I'm Terence. I handle the growth and institutional products at Dinero. We are building the yield base plate of Ethereum, soon to be the base plate for all your stablecoins. And now we're launching some cool institutional products focused on bridging structured vehicles and DeFi yields. So,
my name is Evan. I'm one of the co-founders of Ampleforth. We've actually been working on just this concept of decentralized money for 6 years. We started in 2019 with a decentralized unit account called Ample that grew substantially in 2021. And then we eventually developed a very simple fixed-term tranching protocol that would allow you to reorganize the volatility of Ample into senior and junior tranches. And now we've kind of extended that into a perpetual tranching protocol. So perpetual seniors and perpetual juniors. And so it's what we're working on right now is essentially like low volatility coins, not necessarily stable coins, but I think that there's a great deal of promise there.
Thank you. And ChainSecurity, we are security auditors. We've audited a lot of the projects you've seen on stage today, and we are the people who give you bugs. So if you've ever received this merch of bugs that you can eat, it's from us. All right, so maybe let's start in the recent years, or very recently. What is the most important innovation in stablecoin design that you've seen? Who wants to start?
So from here. Oh, sure. Yeah. So for us, the stablecoin FXUSD, it's 100% capital efficiency, and it's a decentralized stablecoin backed by the ETH, Lido STETH. So every $1 FXUSD, you can always get the $1 worth of STETH. Then you can get the sustainable on-chain real yield by put the FXUSD in the stability pool. So, yeah.
So for me, most innovative, most important advancement in stablecoins recent years, it's all about safety, stability, and safety. Liquidity is rated by bluechip.org, a stablecoin rating agency, as the safest possible stablecoin that's ever been made. So LUSD, what are they doing right? They came up with a redemptions feature. I think FX has something very similar. where you can redeem one stablecoin for the underlying collateral. And that's the most important thing, right? And so that makes liquidity actually safer than USDC, right? Remember USDC depegged 2 years ago, went down to 85 cents. You don't get to call up Circle on the phone and say, hey, Circle, send me 2 of those treasury bills that are backing the stablecoin, right? They don't do that at 2 a.m. on a Saturday. So the redemption feature, we can build decentralized stablecoins that are safer. That's the most important. That's the most important innovation since most important feature since the launch of Maker. Yeah.
I'll just keep the tradition here of pitching our own products.
It's not my products. I don't work for Liquidity.
Yeah.
I don't work for them. They've never given me any money. Not
No,
shilling
joking.
them, and it's not my project. My project's Nerdite. I have immense respect for them, and I think that is, actually the thing that is driving us forward. So
I think the ability for everyone to call something a stablecoin that's not really a stablecoin, we've just kind of gone away. So like you can take Athena and talk about, is Athena really a stablecoin? It's a structured product in a stablecoin wrapper. And so I think that's a really interesting innovation if you are broadening the definition of stablecoin that far. But I think what we're bringing to market, again, the tradition here that you didn't start, is actually the ability for the market to price the different risks on different stablecoins so that you could actually see something like LUSD as being the lowest risk as the market sees it. Or seeing something like Athena being higher risk, or seeing something like Tether being higher risk.
Same. I think that like broadening the scope of narrative around like what a stablecoin actually is probably more important than whatever the stablecoin actually is. Exactly the things that like you're seeing with Athena, like being able to wrap a basis point trade into a stablecoin, crazy. And I think that like a lot of what's left to do is bridging 2 worlds, and you can only do that between shifting narratives. So yeah, I like seeing people think stablecoins are stablecoins when they are structured products.
Yeah, this is a really interesting question for me because me and my team, we've been thinking about decentralized stablecoins for, like I said, about 6 years, and we've looked at a great many things. Rather than discuss a single innovation that I think was really transformative, I think there is like one breakthrough idea that we've stumbled across, and it emerges from a very simple underlying idea, which is that you can't just arbitrarily create or destroy volatility on a balance sheet. So no act of financial engineering can simply create or destroy volatility, but you can reorganize it, right? And in doing so, you can create essentially tranches, right? High and low volatility derivatives where no net volatility is created or destroyed. And the simplest analogy I would draw your attention to is like leverage perpetuals, right? You can imagine that somebody holds a 2x S&P perp and a 0.5x S&P perp together. They multiply into something similar to a 1x S&P perp. It goes the other way as well, where you can take an S&P and reorganize its volatility into something that's significantly more and less volatile, such that the aggregate volatility is conserved. And in doing so, you can create something durable. And therefore, you can create something decentralizable, because I think that if a system ultimately is going to work for some time up until the moment that it doesn't and then relies on a bailout, well, as kind of independent issuers of money, you can't assume that that's available to you, unlike fiat monies, which are very good at bailing themselves out, or even a corporation that might be bailed out, or a bank that might be bailed out. And so this idea that you can create perpetual derivatives in a decentralized and durable way, I think, is a breakthrough idea, which leads me to my next kind of claim here, which is that I think that for a number of reasons, not all reasons, low volatility is greater than no volatility, beginning with the possibility of creating a decentralized low volatility derivative, but extending far beyond that.
So, who is the real user of your stablecoin? Is it people who just want, to do leverage? Is it everyday payments? Is it yield seeker? Who uses your stablecoin? Maybe we can again start with Tao at the end.
Okay. So for us, most of the yield hunter or stable farmer, So for us, we are concentrating on the stable farming part is the people get the on-chain sustainable yield, the yield coming from the amplifier staking reward, since the whole thing like FXUSD and the leverage side, the X position, is all of them together is backed by the reserve. But only the stable side get all the yield from the reserve. So it's an amplified staking reward. Then we have the FX emission, which is our government token emission, and also the perpetual trading fee, right? So any people open the X position or close the X position, 70% of this fee will be going to the stable. So that's why it's very sustainable and it's also transparent. So most of people want to have this stable coin and getting the yield. That's the on-chain yield, no off-chain component. So, yeah.
So for decentralized stablecoins, if it's a CDP model, a collateralized debt position model, which is backed by crypto assets and stablecoins are being borrowed against that, the primary use case for that is getting leverage on the underlying assets. So for Neurite, that's getting leverage on ETH, on wrapped Bitcoin, some other similar assets. For Liquidity, it's just getting leverage on ETH. And we can say a lot about, okay, stablecoins are good for payments and, yield bearing and all these things. But it's a good question because like the underlying, who are we actually building this for? Everyone who's raised money from VCs to build a stablecoin or related product is trying to grow TVL, right? That's the game, grow TVL. And the real customer who does that is the person looking to go long and looking for leverage or looking for loans so they can pay their taxes or buy a car without having to sell ETH, right? So that's who the customer is initially, but we can still build really great payment products, really great things on top of that after reaching a certain size. Maybe it's different for Athena. I don't know. Maybe their customer is like basis traders who maybe are not necessarily always long.
Just people seeking yield.
Yeah, just people seeking yield. Yeah.
Understand a simple trade.
Yeah. But every CDP stablecoin is really built for people looking for leverage.
Well, I would argue that like if you look at Maker or Sky, right, they're actually now just a credit fund, right?
Yes.
And they're rated, like S&P has rated them a B+ credit fund, right? And they're started out as just a CDP for people who want to get leverage, but now it's largely also for people who want to get yield. So it has that dual purpose. And Maker a little bit got into the place where it was being used for payments and had other use cases and other utility that was being permeated throughout the ecosystem, whether it was trading or just DeFi use cases. So that was a really interesting use case for stablecoins. But what you're starting to see is more and more stablecoins that are bootstrapping TVL, using VC dollars to get that TVL in the door initially. And then what do they have left? And a lot of them are building out things that are backed by treasuries today, but ultimately they're going to be competing for yield in the future with some large stablecoin that actually is able to pay out the same yield rate. And so they're just going to have to move up the risk stack. So they're just going to, a lot of these stablecoins are just going to become look more like credit funds. And the innovation there is that basically by using sort of like a rebasing model, you've taken what normally a credit fund does, which has a price based on its NAV, and you basically said the price is $1, I just gave you more shares, which doesn't exist in TradFi. And so you've actually created something that could be more fungible and possibly have more utility as time goes on. The question always is, what's the risk associated with that? When people think it's worth $1, when it may not be actually worth $1 if it's not like having its NAV marked on a daily basis.
Can I ask a side question? Is that allowed? I don't know what the
Please,
rules
feel
are
free.
for panels. Okay. If Maker is a credit fund, but it's over collateralized, there's no credit fund on Wall Street that is like, hey, you have to give us $110 to get $100 in credit, right? That's not how they work.
Sure.
So Maker's over collateralized. It's a CDP.
Maker's over collateralized to the shares that they have issued. If you think about it that way, the shares that they've issued that are the stable shares, they've issued less of them than they could because of that. But it's still they're managing credit risk internally. And so the return that's being generated or the return that they can pay is in theory risk adjusted, right? And so like for a B+ credit fund, when it was paying 13.5%, that was a great trade. At 6.5%, you can probably find a B+ credit fund that's paying a little bit more.
It's a very interesting way to think about it.
So what about you guys? You have different use cases, you think, in your users, or is it kind of similar?
I think the CDP thing, like boiling down to just like users looking for leverage, probably isn't the best way to put it, just because like the best capital efficiency is leverage, right? Like in order to get there, you need to be able to borrow against your dollar. So I think that like a CDP, especially one that's maybe backed by a yield-bearing asset, doesn't just like attract users looking for leverage. Actually largely attracts users looking for like optimal capital efficiency, right? Like if I want to optimize what I can do with my dollar that's pushing back, 5-6 points, then yeah, I want to borrow against it, get some leverage, and then figure out a way to get flat so I can just keep, earning whatever that rate is without having to take on any risk. You know what I mean?
That you just described getting leverage.
It is leverage.
Yeah. Okay.
I love leverage.
I think it's we can move beyond just demand for leverage, right? So I think that one of the great use cases today of decentralized stablecoin protocols like Liquidity and Maker is that if you are long ETH and you want to borrow against it, you can borrow against it, right? But it's extremely capital inefficient, and you pay an interest, and you have to constantly top up that interest. That interest gets passed on to maybe people who stake in a stability module or something like that. I think there is a great deal of demand for leverage out there, but there are a lot of kind of suppliers of leverage, right? It's not just on-chain protocols that are going to give you access to leverage. It's off-chain exchanges and things that can give you access to leverage. And so there's this whole other side of the equation, which is demand for stability. And I think demand for stability has largely been met by centralized stablecoins like USDT and USDC successfully, right? With some exception, of course, they're not censorship resistant. They're highly permissioned. Somebody could freeze your assets and whatever. But in general, if you just want, dollar denominated stability, there's just so much liquidity available in USDC and USDT. And now there's like kind of an emerging market here, which is like, how can I get additional yield on a low risk kind of asset, right? And so that I can outpace inflation, right? We have this new economic pressure here that says like, I don't want to just put a bunch of dollars in a dollar coin. I want to beat inflation, right? But I don't want so much downside deviation. And the trouble with these leverage-based systems, CDP-based systems, and they're very good in a certain way, but the trouble with it is that like the crypto markets go through bear and bull cycles, right? More rapidly even than the macro bear and bull cycles. Like for example, we saw Bitcoin go through multiple winters at a time when it was a money printing bonanza from the great financial crisis until COVID, right? Equities weren't going through those bear markets. And in these micro winters, demand for leverage dries up entirely, and so the yield on these kind of stable assets also dries up as well. So you go from something that might be generating 20% yield to something that's generating like single digit, sub 5% yield in these bear markets, and people pull their liquidity out. That kind of like in and out behavior, I don't think has been very good for our space. So, one of the great questions is like, how can we generate high yield with low risk in a sustainable way? And that's one of the things that we do at Spot. It's just a low volatility derivative, but that volatility is also opportunity. So simply by staking Spot and USDC in a Uniswap V3 LP position, the trading fees harvest kind of this mean reverting volatility and can deliver 20 to 40% APY in a way that doesn't depend on leverage, right? So because it's just buying under a mean and selling over a mean, that kind of behavior can persist even when the demand to borrow dries up. Like for example, right now, I think demand to borrow is probably coming down a little bit. These things will always happen, but I think at the end of the day, the proposition of a stable coin has always been bigger than mimicking the dollar. It's always been about like, how can we create something that's actually stable on a purchasing power basis over the long run, right? If you look at the dollar's purchasing power from 1965 to present, it's monotonically decreasing, right? But if you look at like gold and equities, it's like parabolically increasing, right? So obviously over long time horizons, one outperforms the other. And the question is why, right? Why is the dollar kind of losing value over time in spite of markets generally going up? Well, it's because we're printing a bunch of money to stimulate market growth, right? But that's not being captured in the purchasing power of the dollar. So one of the kind of insights we had is like, we just imagine what would happen if we had a low volatility gold, because like, although this works over long time horizons, over short 1 to 5 year time horizons, it's not stable enough for commerce. It's not stable enough to use as an alternative demand deposit for, just keeping wealth around if you have dollar denominated invoices that you have to draw down from and pay in a 1 to 5 year time horizon. And if you compress the volatility of gold by a factor of 10, instead of something parabolically upward, you just get something that's a little bit more gently upward, which is strictly better than something that's monotonically decreasing. And so for that reason, I think that a low volatility, I question why we would want to create a synthetic dollar that's down and to the right. I really strongly believe in a low volatility derivative like low volatility ETH, low volatility Bitcoin, low volatility gold. Those sorts of assets would completely change the macroeconomic landscape. And I also believe that that volatility can be harvested to generate superior yields that don't depend on leverage. And so to answer your question, our primary use case is like low volatility staking high yield. So you can either have like 5% APY on zero volatility, or maybe you can have 30% APY on 5% volatility.
Thank you.
I was going to say the use case for that is very different than what we would traditionally define as a stablecoin.
Totally different. Yeah.
It's a very different product. It's meant to actually be more for a saver or for someone who's actually
so
looking to match purchasing power.
Maybe since the panel is about securing decentralized stablecoin, maybe we can move on from this topic. Maybe we can go back to it after. So there were large hacks that happened for bridges, for lending protocols, not large hacks for stablecoins. Do you think this is just luck, or is this that stablecoins take security more seriously?
Well, we found a bug in Liquidity, like 10 days ago. That was like $100 million. So there have been, stablecoin issues.
It wasn't a hack though.
Yeah. Okay. Sure. Yes. Correct. Okay. So no more hacks on stablecoins. They're not allowed. So anybody watching this, no, we're not allowed to do any more hacks on stablecoins. It's over from this point. And stablecoins, I'm declaring them safe.
But those aren't a hack isn't the only risk to a stablecoin. There's a lot of risks to stablecoins, especially if you're intending for it to hold a peg and for it to be worth $1. Unique risk, right? And what's happened is that we stopped thinking about stablecoins as actually being forms of credit, right? We've started all stablecoins, whether they're decentrally issued or centrally issued, they're all IOUs.
Unless we're talking about Bean and Pinto, which is a credit-backed stablecoin, and not a Ponzi scheme.
Right.
Thank you.
I think it's a coincidence, or it's just sheer luck that stablecoin protocols haven't been hacked, so to speak. These are just like smart contracts. If there are bugs in them, they can be exploited. I think what is more unique, right, is that we've seen a great many decentralized stablecoins fail by bad economic design, where other things can't quite fail in that same way. Like you can, say in the case of Terra, right, you can completely trash the market attempting to defend a peg with a bad economic design. And that's just as big, if not bigger, than security vulnerability. And I don't think there's anything particularly unique about stablecoins that makes them unhackable. In the case of USDT and USDC, maybe it's just mostly centralized.
I have another theory. The people who design stablecoins are just exceptionally handsome and smart. And
nobody wants to hack them as a result.
That's right. And they're just better.
I can go with that.
Mic off for that one. I didn't like that.
Wow. Okay. They're just they just think about things deeper. Maybe, I don't know. It's probably just coincidental, to be honest.
Yeah, stablecoins have been stolen. Stablecoins have depegged and gone to zero. Stablecoins have depegged and gone down in value because people didn't understand what they were. These things happen. The risk factors in stablecoins are actually huge and largely ignored in the market. But it's just, I think, totally coincidence that they haven't been hacked specifically. Also, in some cases, especially in the instance of a centralized stablecoin, the design is much simpler, right? It's basically I'm issuing an ERC20 token based off of my controller that I'm keeping control of that allows me to issue that based off of something that I have backed. And you don't even know that that doesn't mean that those things haven't been hacked. And that someone has gotten into Tether and just minted a whole bunch of Tether and no one, like Tether's not going to tell the truth about it because why would they?
Interesting. You guys want to add something before we move to the next question? Go ahead.
Do you think that has happened? Do you think there
No.
has been secret hacks to Tether that they're not telling people about?
I don't know that they were hacks.
Is that like the opposite of a Tether truther? It's like a Tether liar?
I actually don't think that happened, but how would we know? Like, there's not that much transparency in what's going on behind the
No,
scenes
I mean,
at Tether.
there were funds seized, for example, like Crypto Capital, the banking partner behind Tether, for example, like, lost access to a bunch of assets. And obviously, they're not going to issue a PR announcement about that. They're going to try to solve it. The fact that it's like completely opaque buys you time. But no, I really do think that there's no reason why a stable coin can't be hacked like any other smart contract.
Actually, I think that's a great rumor to start. That stablecoins don't get hacked, and also that Tether is lying. That would be a great conspiracy theory to start during this panel right now. I think we should.
Exactly the reason why Tether has not been audited is because they were hacked and someone issued an extra $1 billion of Tether, which they used to buy Bitcoin.
All right, somebody cut that into a video and then post it on Twitter, and then remove the facetious comment at the beginning.
I am unaffiliated with this opinion, and I am in this group randomly. All right.
All right, very good.
So, talking about catastrophic cases, let's imagine in the next 5 years, if your stablecoin were to depeg for a longer duration or for forever, what would have caused this to happen? What catastrophe could in the next 5 years cause your stablecoin to depeg? And maybe Phil, you can talk about your stablecoin of choice.
Okay, stablecoin of choice. Let's say Bean, for example, which is currently trading below about 30 cents per stablecoin, which is supposed to be pegged to $1. No big deal.
Sorry, I said Phil because Phil has a different protocol, but it would be ideal if you talk about yours.
Keep talking about Bean.
Okay, yeah, I'm gonna. Okay, sorry. Go ahead. I'm sorry. Get a word in.
Yeah. So actually, for us, we have an advanced pegging system. So we have to make sure the FXUSD is pegging to the $1 very well to make sure the X position can be opening. So if you're talking about end of world scenario, it might be like its price going to less than $100, whatever, or the crypto, the private key having, you can get it or something like that, right? Computational computing or whatever. Yeah, so that's kind of the end of world scenario for the pegging, at least for ours. Yeah.
But you have a redemption mechanism as well,
yeah, we have
right?
a redemption.
So that is actually one of the safest possible scenarios, because even if the price is depegging, of the stablecoin depegging, you can always get out of the stablecoin, right? So that's like a genius design,
You still need a liquidation and the rebalance to make sure the whole system is working properly.
Can you talk a bit closer to your mic?
Oh, yeah. I mean, you still need like liquidation, rebalance or liquidation to make sure you have enough collateral to back all your stable.
Yeah, I mean, it would be like a precipitous fall in price where it was a gap down that you couldn't cover and liquidate fast enough could cause the redemptions to not meet the demand.
Yeah, meeting demand. That's definitely, I think, one of the edge cases. ChainSecurity has audited Liquidity. Nearright, my stablecoin, is a fork of Liquidity. It can't depeg as long as there isn't bad debt, because you can always redeem one USDN for $1 worth of collateral that is backing it at any time, permissionlessly, right? And that's inheriting that design from Liquidity. The redemptions, I think, is just really an incredible innovation just in money in general. So if something's going to depeg like that, specifically a Liquidity style system, then it means it's gotten bad debt, and all of crypto is at zero, and nothing. It doesn't matter anymore. So
I mean, you can just pick apart every single stablecoin and talk about what could cause them to depeg, because every single one of them has risks associated with it, right? Tether could be, we're assuming that there's not bad actors in Tether or hacks there, right? Tether could end up being backed by a ton of Chinese paper that's not marked to market and is worthless and can't be sold, and therefore they couldn't honor 100% redemptions. They could probably honor 95% of redemptions, but not 100%. And so if that information were to be true and leaked to the market, then Tether maybe start being trading at 95 cents, right? Circle, we saw what happened when SVB went down, right? That caused USDC to depeg, and thank God that it had worked out okay for everybody. But you could then think about Athena, right? There was a very brief moment in time where people were worried about USDE, and it did depeg because people saw that they had collateral at Bybit, right? And the $1.5 billion was out the door. Was that their collateral? Turned out it was not at all their collateral. It was totally segregated and not at all at risk. But that could cause it to depeg. So you just keep going down the list. Each one of these has, on top of which, smart contract risks.
Yeah, I think it's probably a losing game to figure out like what the end of the world is for crypto, but it's not a losing game to just make sure you properly manage whatever the collateral is behind your damn coin, and not just properly manage it, but properly select a viable collateral asset, right? Earlier you were talking about USDT, right? And like a lot of these things we joke about, okay, maybe Tether is hacked and someone's waiting for another whatever $1 billion to show up and say, oh, I had the keys the whole time. Off-chain settlement's off-chain settlement. The reason that those things can even exist is because we'll never know about them because they're underwritten by much larger players than any of our protocols could be, right? So yeah, good collateral. Don't misuse the collateral. And yeah, if you have an off-chain book, you have a form of redemption mechanism that's probably better than anything we could build on chain. Right? So,
Yeah, in our case, we can't depeg because we're not pegged. I do not think it's possible to synthetically create perfect stability, right? Just like imagine you're trying to recreate the volatility movement pattern of gold, and I give you $10 billion to do it, right? At some point, an extreme market disruption could cause you to run out of this buffer with which to synthetically create the movement pattern of another asset, at which point you're out of luck, right? And in the case of, CDP-based systems as well, we can just imagine the collateral asset, taking a huge dive, right? Resulting in cascading liquidations. People are buying this asset to liquidate someone and then sell in a spiral, right? Of course it can happen. For me, that's why we don't have a peg, because we want to create something durable. And there's really, you can go really far with this idea of not having a peg, right? It started with that example of imagining you're holding a 2x S&P perp and a 0.5x S&P perp. The combined volatility is 1. Now imagine it's like a 3x and a 1/3 x and a 10x and a 1/10 x and a 100x and a 1/100x, right? This idea of reorganizing volatility without a peg can get you very close to something stable without introducing the fragility of a system that's willing to murder-suicide itself and the space by defending a peg. And so that's why I really believe that it's kind of a breakthrough idea for the purpose of decentralization and durability. But yeah, I do think that, if you are trying to peg an asset to another asset and then you're not collateralizing it with that same asset, you should probably get some insurance on it,
Yes.
range-bound stability is a beautiful thing.
Exactly.
It's
Why
the
not?
land of the free. Stability is scary.
It's not about black and white.
Yeah,
It's about a rainbow.
but you give us a range.
Yeah.
A
to do
range,
something there. A
a
range is
continuum. Everything in the natural universe is continuous and not discrete. Why would we think this is any different?
It's also just about understanding how these things are built, right? Because some of them disguise themselves or are marketed as pegged assets and are, the consumer thinks that it's supposed to hold a stable value when that was actually never the design.
Yeah, and everybody's in this business of apologizing for not being perfectly stable or bragging about how perfectly stable they can be. And if you're bragging about that, either you're centralized or one day, you could be wrong. If you're apologizing for it, you're kind of missing the point, because it's not about zero volatility and zero return. It's about a spectrum of some volatility, some return, high volatility, high return, super high volatility, super high return. And what we can do in between is way more fantastic than a false promise.
Yeah. And these things can all be actually one thing, right? Because like to get to a
course.
point of range bound stability, what do you need before that? No range. Like you
Exactly.
need immense periods of volatility to be able to issue the yield that users in the ecosystems that we all work in want, right? You want to come in, see some ridiculous APY.
Yes.
But the only reason that that exists is to get your collateral to a point of scale where you can switch on range bound stability and actually do something viable, like with size, I think.
Yeah, and the problem with these things being pegged to a dollar when you are starting to take more risk is that they shouldn't trade at a dollar, right? And that's the reason why all of these stablecoins that are treasury backed are backed with very, very short dated treasuries, is because they need to be able to go in and out of them even against interest rate changes and have no volatility against that. As people start competing for more and better yields and start moving up the risk spectrum, they're going to start taking duration risk and be sensitive to interest rate risk that could cause, if you needed to liquidate, losses or gains, right? And these things are pegged to a dollar may not be the appropriate thing.
Look, I think right now the dollar is universally, the global unit of account, and it's not. I mean,
For now.
it goes pretty deep, right? There are all of these international trade invoice agreements, long-lived contracts that are denominated in dollars, right? Say I'm an importer of wheat and I have a long-lived, sales contract. It's denominated in dollars, or exporter of wheat, and the buyer of that has to keep a lot of dollars around in order to fulfill those invoices in the future. And these might not be American entities. It could be an emerging country that has obligated itself to pay off a long-lived invoice that's dollar denominated. What does that mean? It means they need to keep a lot of dollars around. And they don't want to just keep those dollars around for the hell of it, right? And so what does that mean? That means they have to be willing to lend those dollars out at low interest rates. And so the stickiness of the dollar as a global unit of account is profound, and that's why we all care about things that are dollar denominated, right? That's why these businesses, they just can't sit on their local currency. They have to sit on a lot of dollars and then lend those dollars out. But my question is, imagine a slightly different universe, right? Where, yes, I have a bunch of long-lived invoices that I have to pay in dollars, even though I'm not in the United States. But one of the options that I can hold instead of dollars is like a low volatility gold. Let's imagine a 1/10 volatility gold, or maybe a 1/100th volatility gold. Something like that. There would be a reasonable allocation of my kind of holdings that could more than pay off these future invoices. And so, to compete with a dollar, as
You're still paying the invoices off in dollars.
What's that?
But the invoices are still priced in dollars.
Yeah, imagine I owe you $100 million per year for oil that you're selling me. And this is a 30-year contract, right? I better be holding a lot of dollars to pay that invoice off because, well, every other currency other than dollar is is more inflationary, right?
I mean, I don't think this actually moves us to a different system that's that crazy from where we are today, where people actually do similar things like this, and treasury management strategies and
Yes.
corporations engage these kinds of
It's a
strategies.
society settlement.
They
like,
do,
all that matters
but
is
let me just go ahead and expand on that, right? So everybody who's doing this portfolio management thing, they have barbell strategies, right? So
Maybe-
they have assets that they can.
Yeah, if we can make this short because we don't have much time and then
Okay.
we have another question. Yeah, if you can.
Okay,
But we're just getting to the good
to
stuff.
put it
How
briefly,
do we move on to a Bitcoin system?
To put it briefly, everybody has essentially a barbell strategy where they hold zero volatility assets and high volatility assets like equities, gold, etc. The zero volatility assets are their safety buffer. The high volatility assets, they're not supposed to touch for 5 to 15 years. But the concept of safety is highly subjective. Anything can happen. And all of a sudden, the buffer that you've saved here is not sufficient. So you're drawing down from a portion of your fund that you're not supposed to touch for 5 to 15 years. And so there's this massive, messy middle asset class, right? Or opportunity where where do I store value in assets that I may need to draw down from in the 1 to 5 year time horizon? And this is actually the problem that every hedge fund, every private equity fund, money market funds are trying to solve. How do I convert this barbell strategy into something that is an easy hold that's generating a 20% annual rate of return with low downside deviations that I can put money into and not feel bad about drawing out of in a 1 to 5 year time horizon? And I think a low volatility derivative of gold, Bitcoin, ETH, a cryptocurrency, could easily fill that gap. And that's a $26 trillion market.
Moving on to the last question. So we're talking here about decentralized stablecoins. Of course, decentralization is a spectrum. I'd love to hear, maybe starting over there, what trade-offs have you made in terms of decentralization, and where do you think your stablecoin is less decentralized, and why did you make these trade-offs? I'd love to hear. To start with you.
So first of all, the decentralization is important, and also it's transparency, right? So for us, first of all, redemption, you will make sure it's always have been backed by the reserve, and also we're not talking about what's the usage. So we have to make sure it's capital efficiency, right? If you have to over collateralize all the times, then it's not easy to increase the supply. So the supply part will be the limitation of this decentralized. That's why we don't see that much decentralized stablecoin going up to the higher. So that's why for the FXUSD, another key point is it's scalable. So when people open the X position, then basically it's minting the FXUSD on the side. So that's kind of make the supply for the FXUSD much faster. Yeah.
How about you, Joseph? It sounds, when you talk about it, it sounds like you're the most decentralized stablecoin. Did you make any trade-offs, or
Yes,
are you perfectly?
Yes, definitely. Nearite is on Arbitrum, which still has a multi-sig for emergencies in case there's emergency security issues. That's a trade-off. And the collateral types that we take, I think, is probably the biggest centralization risk, because we might take a collateral type that can be upgraded by a different DAO. So that's another risk too, but we focused on governance minimization. No new collateral types can ever be added to Neurite. No contracts can ever be upgraded. If we need to fix something, we have to deploy an entirely new protocol. So whatever we deploy, completely immutable, and that's our take on decentralization and security.
I think that when you're looking at the risk of stablecoins, there are risk trade-offs between centralization and decentralization that come in all sorts of flavors, right? And so in a decentralized stablecoin, you end up with something that you can't fix. And so there can be a bug, there can be something that goes wrong in the stablecoin and you can't fix it. There's nothing you can do about it. Whereas a centralized stablecoin has centralization risk. A single hack or a single takedown can ruin the whole thing, or a single government seizure can take down the whole thing. And I think what's actually probably the most important thing is, as we continue to mature and evolve in this industry, and there are more and more stablecoins with different levels of decentralization, centralization, and different risk factors, is that the market has a way to understand those risks and price them.
Right, and luckily, ours is immutable. We can't fix bugs, like you said, but our team is so cracked, we write all the code perfectly every time. So we don't have any bugs. So yeah, thanks.
Too handsome to get hacked.
Like all stablecoins.
Yeah, exactly. Yeah.
The same way there's like a spectrum of decentralization, there's a spectrum of centralization, right? And I think that there's a lot of good things that you get and still need, specifically for stablecoins today, with more centralization. Like, I don't think we're at a point where you can get to the growth that anyone wants for any of their protocols, whatever it might be, without an immense amount of liquidity that kind of is underwritten by something that we don't see on chain yet. There are stablecoins that are very successful, and like how deep the liquidity is and how much you can actually do with the damn thing. But yeah, I still think I'm not a centralization maxi at all. But I do think that but yeah, no, you need a little bit of it. Like there's look at the biggest stablecoins, USDC, USDT, DAI. Like DAI is not as nearly as centralized.
Liquidity, which went from 0 to 4.5
yes.
billion in 1 month, and has no upgradability or governance.
And USDT and USDT. So
You can build big things without those. So.
you can. I agree. But yeah, there's goods on each side.
What about you?
Yeah, I mean, we've made no compromises on decentralization. But what we compromise is volatility. We're willing to accept some volatility. I mean, you can't have everything, but I think that, we feel strongly that there needs to be something that's a decentralized store value, and that the market can tolerate some volatility, especially if it has a corresponding or greater return profile to it. And yeah, you can grow quick. Like Ample grew from a $20 million market cap to 1.65 billion fully diluted in 30 days, back in DeFi summer. It can grow. But
Take
I mean,
me
again,
back.
that's
DeFi Summer,
tiny
take me back.
compared to a $100 billion market cap of Tether, right? But
Tiny.
All right, guys, that's all the time we have. Thank you very much. A round of applause for our decentralized stablecoins, please. Thank you.
Thank you, everybody.
Thank you.